Have you ever wondered how some investors seem to have a steady stream of income from their portfolios, regardless of the market's ups and downs? The secret might just lie in dividend stocks, a type of investment that not only provides regular payouts, but can also contribute to capital appreciation over time. In today's video, we're diving deep into the world of dividend stocks to unlock the strategies that can help you enhance your investment portfolio. Dividend stocks are shares of companies that return a portion of their profits to shareholders in the form of dividends. Unlike growth stocks, which reinvest profits to fuel further growth, dividend-paying companies reward their investors with regular income, making them highly attractive for those seeking a consistent return on investment. This video will guide you through the basics of dividend stocks, how to pick the right ones, and techniques to maximize your returns. Why focus on dividend stocks, you might ask? For starters, they are a hallmark of financially stable companies with predictable profitability. This can mean less volatility and more peace of mind for investors who prefer a less turbulent investment experience. Furthermore, dividends can be a powerful tool in compounding gains, as reinvesting these earnings can significantly increase the value of your investment over time. By the end of this video, you will have a solid understanding of dividend stocks, equipped with the knowledge to start or enhance your investment journey. Whether you're a beginner looking to make your first investment or an experienced investor aiming to refine your portfolio strategy, the insights shared today will be invaluable. So, let's get started and unlock the full potential of dividend stocks to build a more prosperous financial future. In the realm of investing, understanding the different types of stocks and how they function is crucial for every investor. Dividend stocks represent one such category, characterized by their ability to generate regular income for shareholders. But what exactly are dividend stocks, and why do they hold such significance in an investment portfolio? A dividend stock is essentially a share in a company that distributes a portion of its earnings to shareholders on a regular basis. These dividends are usually paid out from the company's profits, and their amount can vary based on the company's performance and the decisions made by its board of directors. Typically, dividends are paid in cash, but they can also be distributed as additional shares of stock or other property. The primary allure of dividend stocks lies in their dual earning potential: income through dividends and capital appreciation. This means that investors can benefit from receiving regular dividend payments while potentially enjoying an increase in the stock's price over time. For many, this combination offers a compelling blend of income and growth, ideal for those looking to build wealth steadily. Dividend stocks serve multiple roles in an investment portfolio. Firstly, they provide a source of regular income. This can be particularly appealing to retirees or those who need steady income streams to meet everyday expenses. Dividend income can also be reinvested to purchase more shares, a practice known as dividend reinvestment. This strategy allows investors to exponentially increase their holdings and benefit from the power of compounding over time. Moreover, dividend stocks are often associated with well-established, financially stable companies that have a long track record of profitability. Investing in such companies can lower the risk in a portfolio, as these businesses are less likely to experience the high volatility associated with less mature or smaller companies. In addition to providing stability, dividend stocks can also offer a hedge against inflation. Historically, many companies that pay dividends adjust the payout amounts based on inflation rates, which can help preserve the purchasing power of the dividend income over time. Lastly, the presence of dividend stocks in a portfolio encourages financial discipline among investors. Since dividends are paid on a regular schedule, they can help instill a routine of monitoring and managing investments more closely. This ongoing engagement with the portfolio ensures that investors are consistently aligned with their long-term financial goals. When it comes to building an investment portfolio with dividend stocks, selecting the right ones is as crucial as the decision to invest in them in the first place. The allure of a steady income stream might make any dividend-paying stock seem attractive, but discerning investors know that some choices can be significantly more rewarding than others. Let's explore the key criteria to consider when selecting dividend stocks, followed by examples of high-performing dividend stocks and what makes them stand out. Dividend yield. The dividend yield is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. While a high yield is attractive, it's important to understand that it may not always be sustainable. A yield that is too high could indicate that the company is paying out too much of its profits, which might not be sustainable in the long term. Dividend growth. Investing in companies that have a history of increasing their dividend payouts can be more beneficial than those with high yields but no growth. A consistent increase in dividends can signal a company's strong financial health and a commitment to returning value to shareholders. Payout ratio. This is the percentage of earnings paid to shareholders in dividends. A lower payout ratio typically suggests that a company has plenty of room to grow its dividends in the future, whereas a higher ratio could limit growth and might also indicate that dividends are at risk during economic downturns. Company fundamentals. Strong fundamentals such as steady revenue growth, solid profit margins, and good management are critical. A company that performs well fundamentally is more likely to sustain and grow its dividends. Industry stability. Investing in companies within stable industries or those with essential services can reduce risk. These companies are less likely to experience wide swings in their business operations, which supports consistent dividend payments. Economic moat. A company with a strong competitive advantage or economic moat is likely to maintain a dominant position in its industry for a long time, supporting ongoing dividend payments. This could be due to brand strength, unique products, or a large market share. Here are some examples of high-performing dividend stocks. Johnson & Johnson. A prime example of a high-performing dividend stock, Johnson & Johnson has a long track record of paying dividends. It's known for its solid fundamentals, diversified product lines, and consistent dividend growth, making it a favorite among dividend investors. Procter & Gamble. This company has not only paid but also increased its dividend for several decades. With a broad portfolio of everyday consumer goods, PG demonstrates strong sales and earnings stability, supporting its ability to grow dividends. Microsoft. While not traditionally viewed as a high-yield stock, Microsoft has steadily increased its dividends over the years. The company's strong cash flow from its software and cloud services allows it to return substantial value to shareholders through dividends. AT&T. Known for its high dividend yield, AT&T is a good example of a stock where investors need to be cautious about the sustainability of dividends, given its high payout ratio and the capital-intensive nature of the telecom industry. Choosing the right dividend stocks involves a careful balance between attractive dividend yields and the sustainability of those dividends backed by strong company fundamentals. While high yields can be tempting, they should always be evaluated in the context of payout ratios, dividend growth, and the overall health of the company. By prioritizing stocks like Johnson & Johnson, Procter & Gamble, and Microsoft, which demonstrate consistent dividend growth and strong business models, investors can build a more reliable and resilient investment portfolio. Remember, a well-chosen dividend stock not only provides a steady income but also offers the potential for capital appreciation, making it a valuable component of a diversified investment strategy. Investing in dividend stocks is a popular strategy for generating passive income and building wealth over time. However, simply purchasing dividend-paying stocks is not enough. To truly maximize the returns from your investments, it's essential to employ specific strategies and avoid common pitfalls. Let's delve into effective tips for boosting your dividend income and highlight some frequent mistakes to steer clear of. Diversify your portfolio. While dividend stocks are generally considered safer than growth stocks, it's crucial to diversify across various sectors and industries. This diversification helps mitigate risk, as different sectors react differently to economic changes. Including a mix of utilities, healthcare, consumer goods, and technology stocks can provide a balanced portfolio with steady dividend income. Reinvest dividends. One of the most powerful strategies for growing your investment over time is reinvesting dividends. Using dividends to purchase additional shares of stock compounds your earnings and increases your potential returns exponentially as your stock holdings grow. Use DRIPs. Dividend reinvestment plans, DRIPs, allow investors to automatically reinvest their dividends into additional shares, often without any transaction fees and sometimes at a discount. This can significantly enhance your long-term investment returns. Focus on dividend growth. Investing in companies with a history of increasing their dividend payouts can be more beneficial than choosing those with high yields but stagnant growth. Stocks that regularly increase dividends are likely from companies experiencing growth and profits. Tax considerations. Be aware of the tax implications of dividend income. In many jurisdictions, dividends are taxed at different rates than regular income. Structuring your investments to take advantage of more favorable tax treatments can increase your net returns. Also keep in mind the common mistakes to avoid, such as the following. Chasing high yields blindly. A high dividend yield might not always be sustainable. Investors should scrutinize why a stock's yield is exceptionally high. Sometimes, it could indicate underlying problems within the company, such as declining profits, which may lead to dividend cuts in the future. Ignoring company fundamentals, dividends are paid out of profits, and a company that isn't performing well financially might eventually cut or eliminate its dividend. Always assess a company's overall health, looking at revenue growth, debt levels, and profitability before investing. Overlooking economic cycles. Different industries perform differently across economic cycles. For instance, utility companies are known for their stability in economic downturns, whereas consumer discretionary stocks may suffer. Understanding where we are in the economic cycle can help in selecting the right dividend stocks. Neglecting portfolio review. Regularly review your portfolio to ensure that your investments are still meeting your financial goals and adjust your strategy as needed. This includes selling stocks that no longer fit your criteria for dividend investment. Implementing these strategies and avoiding common mistakes can transform dividend investing from a passive income stream into a dynamic component of your financial strategy. By staying informed, proactive, and disciplined, you can optimize your dividend returns and ensure that your investment choices align with your overall financial goals. Always remember, the key to successful dividend investing lies in consistency, patience, and a well-researched approach. Dividend stocks can play a pivotal role in achieving financial independence and securing a stable financial future. By providing a regular income stream, these investments offer the dual benefits of income generation and capital appreciation. Dividend stocks are particularly appealing to those aiming for financial independence due to their potential for generating passive income. This income can serve as a cushion during economic downturns or as additional funding for reinvestment. For retirees, dividends can replace employment income, while for other investors, they can fund further investment opportunities, accelerating the growth of their wealth. The predictability of dividends, especially from well-established companies, adds a layer of security to an investment portfolio. This reliability can be crucial for long-term financial planning, as it provides consistent cash flow that isn't directly affected by market volatility. By reinvesting dividends, investors can benefit from the power of compounding, where not just the initial capital, but also the reinvested dividends grow over time. Incorporating dividend stocks into a portfolio should be done with careful consideration of overall asset allocation. Dividend stocks should complement other investments, such as growth stocks, bonds, and real estate, to create a diversified portfolio that can withstand various market conditions. Sector diversification. Ensure that your dividend stocks span multiple sectors to mitigate risks specific to any single sector. This approach helps in stabilizing returns, as different sectors may perform well at different times. Risk assessment. Assess the risk profile of each dividend stock. Companies with high dividend yields may be riskier, so they should be balanced with stocks having lower but more sustainable yields. Strategic rebalancing. Regularly review and rebalance your portfolio to maintain your desired risk level and investment strategy. This might mean selling some shares in companies that have become less reliable or overrepresented in your portfolio. Growth and value balance. Mix high-yield dividend stocks with those likely to appreciate in capital value. While some stocks provide high immediate returns through dividends, others offer long-term growth potential, enhancing the overall value of your investments. By understanding and implementing these strategies, dividend stocks can significantly contribute to your financial independence, providing a dependable income and a robust foundation for your investment portfolio. Remember, the key to successful integration is maintaining balance and staying informed about market trends and the financial health of the companies you invest in. In today's discussion, we explored the substantial benefits and strategies associated with dividend stocks, essential knowledge for anyone looking to enhance their investment portfolio. We started by defining what dividend stocks are and their role in investment portfolios, providing a foundation for understanding their value. We then moved on to discuss how to choose the right dividend stocks, emphasizing the importance of selecting those with sustainable dividends and solid fundamentals. We also covered effective strategies for maximizing dividend returns, including diversification, reinvesting dividends, and understanding tax implications. Additionally, we discussed how to integrate dividend stocks into your financial plan to help achieve financial independence and ensure a balanced, diversified portfolio. If this information has inspired you to start or review your dividend stock investments, don't hesitate to take action. Whether you're new to investing or looking to optimize an existing portfolio, the right dividend stocks can make a significant difference in your financial growth and stability. Remember to subscribe to the channel and like this video for more insightful financial advice. Your engagement helps us bring more valuable content to you. Let's continue our journey to financial independence together.